Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Welcome back to the Grow Your Wealthy Mindset podcast. Last week, I talked about traditional retirement calculators that can help you figure out how much you need to save and invest during your working years in order to retire. These calculators can be useful to help you gauge how much to contribute towards retirement when you're in the early planning stages. What they don't tell you is the chance of success that if you actually achieve a portfolio of a specific value, whether or not that portfolio will provide you sufficient income for the rest of your life. This week, I'm going to talk about a different type of retirement calculator, what I will call retirement portfolio calculators. These calculators aren't focused on how much you need to save and invest in your working years to build up a portfolio of a certain size. Instead, they focus on how long your current portfolio will last when you're switching from contributing to the portfolio to withdrawing from the portfolio. They aim to answer the question, can you live off your current portfolio without having to work for income? These calculators are often called FIRE calculators because they allow people to see if they've reached financial independence and can retire early. You may be thinking, but I'm sure I can't live off my current portfolio, so this isn't useful to me. For those of you who want to be conservative and not count on using average returns of stocks and bonds, this is a way for you to test a possible future portfolio and gauge better how much you really want to have set aside before you stop working for income. These calculators are also great for people who may be getting close to retirement and want to test their portfolio. In the last episode, I talked about many assumptions traditional retirement calculators make when determining how long your portfolio would last once you stop making contributions and start withdrawing from it. Many traditional retirement calculators do not run Monte Carlo simulations, and even the ones that do often don't show all the data that comes from these simulations. If you really want an idea of whether or not your portfolio will last through your retirement, you may want to run a retirement portfolio calculator that uses a Monte Carlo simulation. A Monte Carlo simulation is a mathematical technique that predicts possible outcomes of an uncertain event. In the case of knowing whether your portfolio will last your retirement, one way to run a Monte Carlo simulation is to simulate a retirement starting point for different past years and see if your portfolio would last the longest time frame you could live. For example, if you want to retire at age 55 and want to plan for the possibility of living to age 95, you would want your retirement portfolio to last 40 years. Historical data could be used to see if your current planned retirement portfolio will be successful. It can run your portfolio through actual past data with different start points to see the probability that there would be money left at the end. This is what was done for the Trinity study and William Bengen's study that led to the 4% withdrawal rate. You could also run the portfolio through simulated possibilities of different stock and bond returns, as opposed to using historical data. There are a few free retirement portfolio calculators online which run these kind of simulations. The simplest calculator I looked at is at thepourswiss.com/fire-calculator. I'll have all these websites in the show notes. This calculator simulates all possible retirement dates in the given years. It checks whether or not you would have money left in your portfolio at the end of the time period. There are only 7 data inputs. The data inputs you enter are the initial value of the portfolio, how many years you want to last, and the withdrawal rate. You can also indicate what years of data you want to use in terms of the start year and end year. The maximum time period is from 1871 to 2022. The calculator also asks how your portfolio is invested, with options like 100% stocks, or 90% stocks, 10% bonds, 80% stocks, and 20% bonds, and so on. You also indicate how often you rebalance your portfolio to the allocation you chose, with options of monthly, annually, or never. The calculator gives you the chance of success and how many scenarios will run. It also tells you the highest and lowest value of your portfolio at the end date for all the simulations that were run, as well as the median and average value. For a portfolio of $3 million lasting 40 years using data from 1950 to 2022, a withdrawal rate of 4% on an 80% stock and 20% bond portfolio that is rebalanced yearly, the chance of success is 83.34%, or 334 out of 396 scenarios. The highest value of this portfolio after 40 years would be over $158 million, which would occur if retirement started in April 1982. The worst is that the portfolio is completely depleted and has no value, which is expected whenever the success rate is not 100%. The shortest time the portfolio lasted was 289 months, which happened when retirement started in December of 1968. The portfolio would have lasted a little over 24 years in that case. The median value was around 38 million, and the average value was around 47.6 million. Hearing the differences in the outcomes of the portfolio, from being anywhere from 0 after 25 years to being worth over $158 million in 40 years, shows how variable the outcome can be. In most scenarios, there will be a huge surplus towards the end of life, but it comes with a 15% chance of the portfolio not having any value at all. This is why I think it's so valuable to run these scenarios, to get the idea that most of the time you're actually going to end up with a lot of money left at the end of life. But what you really want to avoid is running out of money before the end of life. Another calculator that runs multiple scenarios can be found at firecalc.com. With this calculator, you can enter more customization. The minimum data it requests is your annual spending, the value of your portfolio at the start of retirement, and how many years you want the portfolio to last for. There are multiple other optional inputs as well. You can, but don't have to, specify if there'll be any other income that would start at a later date, like if you start receiving Social Security payments at age 70. You could also specify if you plan on retiring in a future year and how much you plan on contributing until you retire. With FireCalc, you can adjust how your spending will vary with 3 different options. You can also specify how your portfolio is invested. FireCalc adjusts for inflation, defaulting using actual historical inflation rates based on CPI, but you can change the inflation assumptions if you want to. When I put in data to match what I entered in the Poor Swiss Fire calculator, FireCalc found a similar success rate of 86% success in 98 out of 114 cycles. The lowest and highest portfolio balance at the end of retirement was minus $3.3 million to positive $37.2 million, with the average at the end of the 40-year period being almost $7.9 million. The average and high values found were actually much lower for FireCalc compared to Poor Swiss. This may be because FireCalc gave a negative portfolio balance, whereas Poor Swiss gives a more realistic 0, since your portfolio can't actually become a negative number unless you're investing with leverage, like with options. However, if it starts averaging those negative numbers with the positive numbers, that would bring down the overall average. Yet another calculator that uses historical data is ficalc.app. ficalc's strong point is that it has a lot of different withdrawal strategy options, 12 options in total compared to FireCalc's 3 options. The default is constant dollar, but there are 2 options to maximize spending and 7 options to maximize longevity. The calculator also gives information on how each withdrawal strategy works. You're also able to specify your portfolio's asset allocation between stocks, bonds, and cash, as well as indicate fees for each allocation. After all, I've talked in the past about how much fees can impact the growth of your portfolio. For the same $3 million portfolio, being used as an example again, using a constant withdrawal of $120,000 a year adjusted for inflation, FICalc.ab gave a 94.7% success rate with 108 out of 114 simulations, significantly higher than the other calculators' estimates, which were closer to 85%. The value of the portfolio after 40 years ranged from 0 to over 54.8 million, with an average of 12.1 million and a median of 7.8 million. If instead of using a constant $120,000 withdrawn each year, I chose to withdraw 4% of the value of the portfolio with a minimum annual withdrawal of $80,000, now the success rate becomes 100%. With the portfolio value between 2.2 million and 17 million, with an average of 6.3 million at the end of 40 years. While there are some years where only 80,000, the set minimum, was withdrawn, the average withdrawn is $184,545, and the largest, $705,321. The median spend is $158,121, which is above the $120,000 constant withdrawal rate. This just shows that in good times you can withdraw more, and when the market's not doing as well, withdraw less. And being flexible like this can make your portfolio be assured to last your lifetime. There are other calculators as well, including cfiresim.com and one that's at engaging-data.com. I chose the three that I thought demonstrated varying levels of complexity. But if you want to try these other calculators out, I'll have their websites listed in the show notes as well. So far, all the calculators mentioned have used historical data. What if the market in the future doesn't act like it has in the past? PortfolioVisualizer.com allows you to not only run simulations based on historical returns, but also use forecasted returns, statistical returns, or parameterized returns. Let's review each of these options. With historical returns, you can choose to use full US history, or you can choose a start year and an end year. Forecasted returns use any forecasted mean and standard deviation of assets. You can choose between normal returns or using a GARCH model. The software allows you to set a risk-free rate of return. You can also choose to upload your own correlation matrix if you want to get really fancy. Statistical returns simulate future returns based on mean, volatility, and correlation. With parameterized returns, you can choose between a normal distribution and a fat-tailed distribution. With normal distribution, you choose the expected return and the volatility. With the fat-tailed distribution, you choose the number of degrees of freedom, as well as the expected return and volatility. To use this calculator, you start by entering the initial amount of the portfolio. The next input is how you want to adjust the portfolio over time. You can make selections like no contributions or withdrawals to see how the portfolio changes over time due to market forces. You can also choose to withdraw a fixed amount periodically or a fixed percentage periodically. Both of these are reasonable methods to do during retirement. You can also choose a rolling average spending rule and specify the rolling average period or percentage. Or choose the geometric spending rule, where you specify the withdrawal percentage and the smoothing rate for inflation-adjusted previous period spending. You can also choose withdrawal based on life expectancy and specify your current age. For maximum customization, you can even import a file that specifies how much to withdraw each year. The software lets you decide how many years to simulate. You can specify pre-tax, or if you're using statistical and forecasted return models, you can also select post-tax returns. You have the choice between a historical inflation model or a parameterized inflation model. If you choose to parameterize inflation model, then you can specify the inflation mean and the inflation volatility. The program gives you the ability to put your portfolio through a sequence of returns risks by allowing you to choose if you want to have the worst years first. And how many bad years do you want? Up to 10. Of all the calculators, this one gives you the most options regarding the investments in your portfolio. Not only can you specify the percentage you have in stocks and bonds, you can actually state what type of stocks and bonds are in your portfolio, as well as choose assets like REITs, gold, precious metals, and commodities. There are 11 options for U.S. equities alone, with choices like U.S. stock market, meaning the whole U.S. stock market, or you can be specific and actually state what percentage you have in, let's say, U.S. large cap value and U.S. mid cap growth. International equities have 7 different options, and fixed income have 16 options from cash to all the different types of bonds. You can really play around with your investments in your portfolio, as well as test different withdrawal options, so you're really putting your portfolio to the test. This is the one for real money nerds out there, and is likely overkill for most people. One caveat to consider when using non-historical values, and especially when using parameterized returns, is that it can underestimate a large market crash, like the one that happened that caused the Great Depression. If you really want to see if your retirement portfolio is bulletproof, add in that sequence of returns risks. Have fun playing with these calculators. I know I did in preparation for this episode. It actually gave me a lot more confidence that my portfolio will last 50 years or indefinitely. If you would like my help looking at your retirement portfolio or your saving and investing plan for retirement, feel free to set up a free Zoom meeting with me at www.growyourwealthymindset.com. As always, you can email any questions, comments, or feedback to growyourwealthymindset@gmail.com. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you're enjoying these episodes, please share with your friends and colleagues, or write a 5-star review with whatever podcast app you're using. I would love your help in reaching more physicians so that we can all become financially savvy and enjoy this one and only life. And again, thank you so much for being a listener. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.